Silver is $93.66 on your brokerage screen right now. That number is a lie. Not because someone manipulated it, not because of a glitch, because that number comes from a market that closed on Friday afternoon and will not open again for another 34 hours. The COMEX is dark. The London bullion market is dark. Every major derivatives exchange that touches precious metals in the Western Hemisphere is frozen. And while those markets sit silent, while your ETF is locked and your futures contract is locked and your mining stock is locked, the physical market in Shenzhen, China is open. It has been open all weekend. And right now, on Saturday morning, February 28th, 2026, the cash buyback price that dealers in the largest precious metals trading hub in Asia will hand you for a physical ounce of silver is $120. That is a $27 gap. Almost 30% between what the frozen paper market says silver is worth and what a real dealer standing in front of real metal will pay for it right now. And those dealers, the professionals whose entire commercial existence depends on converting inventory into cash, are refusing to sell at $120. They believe that number is still cheap. OG John AG here. This is financial warfare education, not hopium. That means we go through both sides. We are going to look at exactly what is happening right now. The geopolitical events, the physical price signals, the mechanics of what Monday morning looks like, and we are going to be honest about what this means and what it does not mean. Because there is a real difference between understanding a structural shift and gambling your life savings on a weekend headline. Let me show you what the data actually says. Segment 1. What is actually happening right now. Let me start with the confirmed facts as of Saturday morning, February 28th, 2026. Because in a weekend like this one, separating confirmed from rumored is the most important thing you can do. Confirmed. The United States and Israel executed coordinated precision strikes on multiple military locations across Iran as part of what the Pentagon is calling Operation Epic Fury. The strikes targeted military infrastructure, defense sites, and locations connected to Iran's missile program. President Trump confirmed the operation on Truth Social. Israeli sources confirmed the strikes through official government communications. Confirmed. Iran has retaliated. Ballistic missiles and drones have been fired at U.S. military bases across the Gulf region, at Israel, at the United Arab Emirates, at Qatar, at Kuwait, at Bahrain, and at Jordan. Dubai International Airport, the world's single busiest international aviation hub, has been struck and suspended operations. Emirates Airlines has suspended all flights. Qatar Airways has suspended all flights. Confirmed. Iran's Navy has declared the Strait of Hormuz shut. Ships in the region are receiving radio broadcasts from the Iranian Navy, banning all transit. Tankers are already diverting. The Strait of Hormuz is the narrow waterway through which approximately 20% of the world's daily oil supply transits every single day. Confirmed. Pakistan's defense minister declared open war with Afghanistan on Friday. Pakistani Air Force strikes hit Kabul, Kandahar, and Paktia. Afghanistan struck back. Two declared active wars are burning in the same geopolitical arc on the same Saturday morning. Confirmed. The tokenized gold market, blockchain-based instruments that trade 24 hours a day, 7 days a week, and cannot be halted by any exchange, is printing $5,494 per ounce. Gold closed Friday at $5,278.20. That is a $216 gap in the only precious metals market currently providing live price discovery. Confirmed. Physical silver buyback price in Shenzhen, China, the largest precious metals trading hub in Asia, is $120 per ounce. International paper close Friday was $93.66. That is a $27 gap, 28.8%. Those are the confirmed facts. Everything else right now is speculation, including what happens next. And I want to be very clear about that distinction before we go any further. Segment 2. The Shenzhen signal. Why $120 matters. Let me explain why the Shenzhen buyback price is the most honest number in this entire situation. Most retail investors and most financial media track one number for silver, the COMEX spot price or the London spot price. These are the official internationally quoted benchmarks, and they are derived from futures contracts. Paper agreements to deliver silver at a future date. No ounce of silver has to change hands for that number to be calculated. The Shenzhen buyback price is different. This is cash money handed across a counter in exchange for a physical ounce of silver, a human seller, a physical product, a real market clearing at a real price in a market that is open right now while the COMEX sits dark. The Huaqiangbei district in Shenzhen is the largest concentration of physical gold and silver dealers in all of Asia. These are not speculators. These are not ideological silver stackers making philosophical arguments about fiat currency. These are commercial businesses, dealers, distributors, traders, whose entire operation is built around the physical transfer of metal. They understand margin and cash flow and carry cost better than almost anyone on this planet. When those dealers, on a Saturday morning with bombs confirmed over Tehran, set a buyback price of $120 per ounce. They are not being emotional. They are being professional. They are looking at their supply chain, looking at the direction of demand from industrial and sovereign buyers, looking at what replaces $120 ounces when they sell them, and concluding that $120 is underpriced. Their refusal to sell at prices they have never seen before is louder than any analyst note published this weekend. Now here is what makes the Shenzhen premium structurally important rather than just a war reaction. The Shanghai silver premium was already running $14 above international spot price in the weeks before this weekend, not because of a war, because physical demand from Chinese industrial buyers, solar manufacturers, EV producers, electronics companies, was already overwhelming the supply available at prevailing paper prices. China reclassified silver as a strategic material and restricted its export. COMEX vaults were already draining at 785,000 ounces per day. The Shenzhen $120 is not a war premium layered on top of a stable baseline. It is a war premium stacked on top of a pre-existing structural supply squeeze. Two independent forces driving in the same direction simultaneously against a paper market that has acknowledged neither. Segment 3. The Strait of Hormuz. What 20% of world oil supply means for silver. Now let me connect the geopolitical event to the metals market, because the connection is not what most people think. The obvious connection is safe haven demand. War happens, gold and silver go up. That is real, and it is part of what is happening, but it is not the most important part. The most important connection is inflation, specifically supply-driven inflation arriving into an economy where the Federal Reserve is arithmetically trapped. The Strait of Hormuz is 21 miles wide at its narrowest point. Every day, approximately 20 million barrels of oil transit through that passage, roughly 20% of the world's daily oil supply. Japan, South Korea, Taiwan, India, and China are all critically dependent on that oil flow. Iran does not need to defeat a carrier strike group to inflict catastrophic economic damage. It needs only to make the passage credibly dangerous. The moment shipping insurance underwriters conclude the strait is at war-level risk, tankers reroute or anchor. The moment tankers anchor, supply disruption arrives that cannot be immediately replaced from alternative sources. The 1973 Arab oil embargo, a supply disruption smaller in proportional terms than a Hormuz closure would represent today, pushed U.S. inflation to 12%. Equities collapsed. Gold tripled in the aftermath. But here's the difference between 1973 and today. The Fed managed the 1973 shock with the option to raise rates aggressively into the inflation. The Federal Reserve today cannot raise rates into a war economy experiencing supply-driven inflation without triggering a debt service crisis on a $38.5 trillion national debt that is already consuming more than $1.2 trillion annually in interest payments. The Fed is not merely constrained, it is arithmetically trapped. Every path available to it amplifies one problem while worsening another. And in a world where the central bank's primary inflation management tool is unavailable, hard assets reprice to absorb the monetary pressure that paper instruments can no longer contain. The PPI data that arrived days before the strikes began, headlined 0.5% month over month versus 0.3% expected, core year over year at 3.6% versus 3.4% forecast, confirmed that inflation was already re-accelerating before a single missile was fired at Iran. This is not a war story layered on top of a stable economy. It is a war story layered on top of an economy that was already showing stagflation signals. Segment 4, the Pakistan dimension. The war nobody is talking about. Here is the piece of this weekend's picture that almost nobody in the Western financial media has connected to the precious metal story. On Friday, February 27th, the same day silver closed at 93.66, Pakistan's defense minister formally declared open war with Afghanistan. Pakistani Air Force strikes hit Kabul, Kandahar, Paktia, and Jalalabad simultaneously. Afghanistan struck back with drone attacks and ground operations. Both sides are reporting significant military casualties. Think about what that picture looks like from 30,000 feet. There are now two simultaneous active wars in the same geopolitical arc. Iran is being struck from the west. Pakistan and Afghanistan are in open armed conflict to the east. The entire corridor from the Persian Gulf to the Hindu Kush is an active military escalation simultaneously, on a weekend when every traditional financial market is closed. Now here is the critical detail that separates this conflict from a standard Pakistan-Afghanistan border exchange. Pakistan is a declared nuclear weapon state with an estimated 100 to 170 warheads. When a sitting defense minister of a nuclear-armed state uses the words open war, that is not a rhetorical device. It is a legal and strategic declaration that removes the ceiling on escalatory options. For silver specifically, the Pakistan dimension matters in two ways. First, Pakistan's Balochistan province contains significant mineral extraction infrastructure that feeds global supply chains. Second, and more immediately, Pakistan's institutional investors and high net worth population are watching their country enter declared open war on a Friday afternoon while Iran is being bombed simultaneously. They are not allocating capital into equities on Monday morning. They are doing exactly what every historical precedent says they do in a war economy. They are moving into hard assets, into gold, into physical silver, into the metals that do not lose value when the government suspends normal operations to fund a military campaign. This is not one geopolitical shock. It is a regional architecture of simultaneous conflict across the entire arc from Tehran to the Hindu Kush, unfolding on a weekend when the paper market is dark and the physical market in China is already at $120. Segment 5. What Monday morning actually looks like. Let me walk you through Monday morning mechanically, because I think the scale of what is building is being underestimated. Every institutional investor, every commodity trading desk, every systematic fund running momentum-based strategies arrived at the same place Friday afternoon. Plans to add precious metals exposure. Then 2 wars broke out over the weekend. Every one of those plans has spent 34 hours accumulating compound conviction. The tokenized gold market printing $5,194, $216 above Friday's close, is the only functioning price signal in traditional precious metals right now, and every institutional desk can see it. Every portfolio manager who went home Friday with gold at $5,278 is watching 2 wars unfold and watching the only functioning price signal tell them the new price is $216 and higher. They have had 34 hours to prepare exactly one trade, their Monday open buy order. The pent-up institutional demand building behind that closed gate is not a trickle. It is a dam. Normal demand distributes itself across a trading session. This demand arrives simultaneously the moment the gate opens. The price discovery that would have occurred over hours if this event had broken on a Tuesday is instead compressed into the first minutes of Monday trading. The opening is not gradual, it is instantaneous. There is a historical parallel that makes this dynamic clear. When equity markets reopened following the September 11th attacks after a multi-day closure, the selling that had been building during the shutdown arrived all at once. The move was historic in its speed and magnitude precisely because demand had accumulated during enforced inaction. The parallel for precious metals buying demand building right now is direct. Same compression, same forced accumulation, same gate opening Monday morning to let it all through at once. Then the short squeeze begins. Every trader who was short silver at $93, who believed the rally was technically overextended, wakes up Monday to a position that is deeply underwater. Margin calls are not a choice. The brokerage calculates the loss against available collateral and issues a liquidation order. Forced buying pushes the price higher. Higher price triggers more margin calls, more forced buying. The cascade compounds with mechanical precision. In silver, whose market is structurally small relative to the capital looking to enter or exit it, this cascade is the most violent repricing dynamic available in commodity markets. Now add the retail layer. Millions of individual investors are going to open their phones Monday morning, see the silver chart, see the war coverage, and make the same calculations simultaneously. They are going to flood into ETFs, into online dealers, into futures. The online dealers who were selling silver at a modest premium over spot on Friday afternoon are either going to be sold out by Monday morning or are going to have adjusted prices to reflect a market where every buyer wants in and no one is willing to part with metal. Segment 6. 3 scenarios. Honest probability assessment. Let me give you 3 specific scenarios with honest probability assessments, because vague predictions are not useful on a weekend when the situation is evolving by the hour. All 3 scenarios now have to be evaluated against a 2-war backdrop. Both conflicts confirmed, both unresolved, both potentially escalating. Scenario 1. Contained dual de-escalation. Iran and the U.S.-Israeli coalition reach a rapid understood boundary. Pakistan and Afghanistan return to the ceasefire pattern established in October 2025. Neither conflict escalates further. In this scenario, gold consolidates between $5,200 and $5,500. Silver holds above $100 on the international market. The Shenzhen premium begins to narrow. This is the most optimistic resolution available. Note what the floor of this optimistic scenario looks like. Gold and silver at all-time highs simultaneously while a ceasefire is in place. Scenario 2. One conflict expands. Either Iran retaliates in force and threatens the Strait of Hormuz at a level that disrupts shipping insurance, or the Pakistan-Afghanistan conflict deepens into a sustained campaign creating conditions for a broader regional emergency. Oil spikes toward $150. Inflation reaccelerates into an environment where the Federal Reserve is arithmetically constrained. In this scenario, gold moves decisively above $6,000. Silver moves above $150 internationally. Scenario 3. Convergent regional breakdown. Both conflicts escalate simultaneously. Iran activates Hezbollah, Houthis, and Iraqi militia. The Strait of Hormuz comes under active threat. Pakistan's nuclear posture enters the strategic conversation. In this scenario, safe haven demand is not additive, it is multiplicative. Gold targets $8,000 to $10,000. Silver targets $200 or higher as silver's pre-existing physical supply crisis collides with the largest simultaneous safe haven demand event in modern financial history. I am not predicting Scenario 3 as the base case. I'm telling you that on Thursday this week, Scenario 1 was still the consensus view. Tonight, with strikes confirmed over both Tehran and Kabul, with two defense ministers on two separate borders having used the word war within 24 hours of each other, Scenario 2 is the base case and Scenario 3 is no longer theoretical. Segment 7, the honest bear case. Now the other side, because this is financial warfare education, and the bear case deserves full respect. Wars have historically caused sharp spikes in precious metals, followed by sharp reversals when the situation stabilizes. The Gulf War in 1990. Gold spiked and then fell back to pre-war levels within months of the ceasefire. The 2003 Iraq invasion, a similar pattern. The market prices the fear, and when the fear proves larger than the actual disruption, the reversal is painful. The tokenized gold market printing $5,494 is trading in thin weekend liquidity. A smaller amount of capital can move that market more dramatically than it would during regular trading hours. The gap between $5,278 and $5,294 may partially represent thin market noise rather than a pure fundamental repricing. CME still has emergency tools, margin hikes, circuit breakers, liquidation-only orders. They have used these tools before in stressed situations. They can use them again. These tools do not resolve the underlying physics, but they can suppress the paper price independently of physical reality in the short term. The $27 Shenzhen gap may partially compress if the immediate shock subsides before Monday's open. A ceasefire announcement, even a temporary pause, between now and Sunday night's Asian session would dramatically change the Monday open mechanics. If you are leveraged into silver derivatives going into Monday, you are exposed to the downside of Scenario 1 as much as the upside of Scenario 2. The same compressed demand dynamic that creates violent upside creates violent downside if the situation resolves faster than the market has priced. Both the bull and bear cases agree on one thing. The paper market at 93.66 is the outlier in this data set. Everything close to actual physical metal has already moved past it. The direction of eventual convergence between paper and physical is not ambiguous. The timing and the path are. Segment 8. The coin shop reality check. Let me bring this from macro theory to the ground level, because the ground level is where the real signal lives. Coin shops across the U.S. on Friday afternoon, before the strikes were confirmed, were already reporting the same split reality we have been tracking for weeks. Front cases, American Silver Eagles, Mercury Dimes, pre-1964 90% silver, flying out. Priced and gone before they could be restocked. Back rooms, sterling silverware, bulk junk silver, old jewelry, backing up. Refiners delaying pricing on specific categories. Now think about what Monday morning looks like for Harry at your local coin shop. He wakes up. He sees the news. He opens his phone and sees silver charts. He has been selling eagles to people who understood the structural story for months. Now the people who didn't understand the structural story are going to walk through his door with cash asking for eagles he may not have. The coin shop layer is the retail confirmation of what the Shenzhen institutional layer is already pricing. Physical in your hand cannot be margin called. Physical in your hand did not gap down over the weekend. Physical in your hand exists at whatever the real world market is willing to pay for it right now, and that price is $120 in the largest physical trading hub in Asia. This is not a moment for celebration. Real conflict is unfolding. Real people are in danger, but it is a moment for clarity about what physical ownership of metal means versus paper claims on metal when the gate is closed and the world is changing on the other side. Segment 9. What to actually watch between now and Monday. Here is your specific watch list for the next 34 hours, all public, all free, tokenized gold price. Track this in real time. It is the only functioning precious metals price signal until Sunday night's Asian Open. If it holds above $5,400 through Saturday, the institutional signal is sustained. If it falls back toward $5,280, the immediate panic is partially pricing out. Iranian retaliation scope. The difference between Scenario 1 and Scenario 2 is what Iran does in the next 12 to 24 hours. Strikes already happened. If Iran's response is contained to the attacks already executed, Scenario 1 probability increases. If Iran announces Strait of Hormuz closure enforcement with naval assets, Scenario 2 probability becomes near certain. Pakistan-Afghanistan ceasefire signals. Watch for UN or Chinese mediation announcements. China called itself deeply concerned. India condemned the strikes. If either China or India moves from statement to active mediation, the Eastern conflict may de-escalate faster than the Western one. Sunday night Asian session. This is your first read on where paper markets think Monday opens. When Tokyo and Hong Kong open Sunday evening U.S. Eastern Time, the futures contracts that trade on Asian exchanges will give you the institutional consensus on gap size before New York opens. Online silver dealer premiums. Check JM Bullion, APMEX, Gainesville Coins, SD Bullion. If they are sold out of Eagles by Sunday morning, the retail demand compression has already begun. If premiums are up 30% or more, the physical market is already pricing the Monday gap. COMEX registered silver daily report. Monday morning first thing. If registered silver shows further drain on Monday after weeks of falling toward 86 million ounces, the structural story and the geopolitical story are compounding simultaneously. Outro. I sell nothing. No courses, no Discord, no signal groups, no affiliate links. If you see my name on a paid service, it is a scam. You find me here on YouTube and on X. The paper market says silver is $93.66. The Shenzhen physical market says $120. The tokenized gold market says gold is already 216s above Friday's close. And the dealers closest to the physical supply chain, the people whose commercial survival depends on getting the price right, are refusing to sell at $120 because they believe the number is still cheap. 2 out of 3 markets that are currently open have already moved past Friday's close. The third market, the paper market, has been locked since Friday afternoon and will not open for another 34 hours. When those 3 markets are forced to speak to each other Monday morning, 34 hours of accumulated institutional demand, retail demand, short covering, and geopolitical repricing arrive simultaneously. That is not normal trading. That is a gate opening. Whether you hold physical, whether you hold paper, whether you hold nothing, understand what you own and what it means in a weekend when the world it is priced in has fundamentally changed since the last closing bell. This is financial warfare education, not advice. Do your own research. Pull the data yourself. Watch the Asian session Sunday night. Watch the tokenized gold print. Watch what Harry's coin shop looks like Monday morning. And never confuse a paper price with a physical reality. If you watch this far with your brain turned on, drop OG John AG in the comments and tell me, physical or paper going into Monday? I am reading every comment. OG out.